Good morning, Trinidad and Tobago, and welcome once again to the Bourse Report. What else are we going to talk about today other than the budget, the national budget 2018 to 2019? Very significant budget. Major moves have been made in the past fiscal year, and we will want to see how that translates into the fiscal situation for the year ahead. Particularly matters such as Petrotrin, the need to find almost $2.2 billion to make retrenchment payments when and if that happens. And other factors rather anomalous to the budget has been, well, we are seeing some closing of the fiscal gap, but we are seeing significant tightening in terms of releases from the Ministry of Finance to meet particular expenditures and so on. Those are the issues that we have to face. I am going this morning to set out over the next few minutes the framework in which the budget is not only going to be presented, but where there are gaps. Critical and most important, let's start with what really we need to be looking for, what's going to happen today. Well, first of all, we have had a situation of increase in debt, one, and continuing deficits in terms of the budget. What has happened then is we continue to borrow or raise financing otherwise to meet that deficit. And therefore, the debt is continuing to rise. And until and unless we get good, sustainable growth in GDP, the debt will reach levels where they may be unsustainable. One, our ability to borrow internationally is going to get more and more challenging, in particular if our credit rating starts to fall. Those are some of the issues, and we can drill down further. I'm going to be having a little chat with Hema just after this so that we can delve more into some of these particular areas. So let's look at what happened over the past year and bring ourselves up to the latest statistics available, which will show us up to the 9-month period, October to June. And then the Honorable Minister, we expect, will fill in the gaps as we go forward into 2018-2019 budget later today. So we started the year with the expectation of core revenues from taxes being $37.3 billion, expenditure $50 billion, and a fiscal gap to be funded by borrowing, divestment, and or the Heritage and Stabilization Fund in the order of $13 billion. Borrowing was expected to be $4.5 billion, and the rest of the funding to make up this 13.2 would have been somewhere in the region of $7.5 billion. Fast forward now to the mid-year review, and which is the second half of the year. And what we would have seen is that total revenues would have been expected to go up to $44.6 billion, arising from a better take in terms of taxation and in terms of oil revenues. Remember, tax rates went up from 30 to 35% in certain cases, but oil revenues as well. Because of the price of oil going above $50, it triggered supplemental taxes and other taxes in the oil sector. Revenues up, curtailment of expenditure from that $50 billion to just $48.9 billion. And then the fiscal gap outturn was expected to be about $4.2 billion thereabouts. How was that to be financed at the half year? Well, net domestic borrowing turned out was in the order of $1.8 billion as to be expected, and funding from divestment, or should I say transferred from divestment, which was the sale of assets gained by the government from the collection on CL Finance and CLICO debts, translated then into NIF, which was really an asset-backed financing of those assets that were collected, a borrowing against those assets, which eventually went into the coffers of the government. So we've had a situation where it is expected by the end of this year that we have that $4 billion in NIF, net borrowing of $1.8 billion, and net external borrowing of $1.3 billion. Let's go now to some of the other things that we have to look at. I've mentioned already that crude oil prices were up. And in US dollars, crude oil prices, the outturn for the first 9 months, and we wait to see what the next 3 months, the last 3 months were. From $1.2 billion, it went down to 0.8, back up to 1, and now 1.2 in those 9 months. A good figure to talk about in terms of the direction. And in terms of value, though, even though oil production has been falling, and we've learned a lot about this, even though oil production has been falling, what? The fact is that it has fallen from 19.9 to 18.7 million barrels for the 9-month period. But oil price has gone up. So when you look at this chart, what you see, the nadir at $40.26 average price, and it has been going up. So in a sense, the value of production of oil has actually gone up. Fast forward now to the whole question of why the value of production has gone up, output value. Look at oil price. Over the period 2017, going up, and it's about, at the last look, $74. So it is in the 70s using WTI prices, and this has gone up. This is a good indicator for government. What we are seeing is that the budgeted price was $52. The average price for that entire 9-month period was actually $62. We expect that the oil price budgeted figure would be somewhere higher than 52, and I would guess it would be somewhere in the vicinity of about $60 or a shave below, maybe. And that is going to impact the expected revenues from the budget 2018 to 2019. Other factors in the energy sector, of course, natural gas production in terms of barrels of oil equivalent is about 80% of energy production. And what you've seen is that when it went down last year, 2017, it's up for the 9 months, up by 32.7 million cubic feet per day for this entire period. So these are factors that the energy sector is doing better than last year. And the energy sector is making significant contributions and, in fact, growing contributions. This graph is somewhat obfuscated because of reclassification of the petrochemical sector, which was moved out of energy recently into manufacturing, consistent, of course, with international practice and benchmarking. But it obfuscates the figures going forward, and we'll talk a little bit more about that. Let's now turn very quickly to the next factor. One of the important factors that the international investors look at, and we as well should look at, is debt to GDP. The numerator debt and the denominator GDP in nominal terms. So what has been happening? We have seen GDP in nominal terms at a low level in 2016, 2017, and it is expected, this is by the projections of the Honorable Minister, to go up to 2% in this last year, 2018, to a nominal figure of $168 billion. And in 2019, 2.2. The most recent figures of the IMF suggest that it is going to be lower. Their expectation by their publication, I believe, on the 25th of September, very recent, their expectation is that the figure is going to be, real GDP is going to be more like 1% and then 0.9% in 2019. So let's put that into the mix and have a better look at what is happening. Now, central government expenditure. Let's see what's happened with central government expenditure as you push outwards. Essentially, government expenditure has been going down 18 over 17. As you can see, at the 9-month period, 36 billion. In this last year, 33 or 34 billion. That decline is probably where citizens are feeling that tightness in terms of expenditure and the impact that you are seeing on the economy, the tightness in the economy. So these are some of the graphs that I wanted to show, and the question is this year ahead. So we talked about debt, the need to control debt, we need to get GDP up so that our debt ratios could be in good order. But we have financed over time a chunk of our expenditure through the divestment of assets, and more recently through asset-backed borrowing using the NIF. And what we see when we look over the past years, the first IPO, this is the FCB IPO in 2013, raised $1 billion. The TTNGL IPO in 2015 raised $1.5 billion. The first APO, $1.3 billion, and the TTNGL APO, $0.85 billion. This year, $4 billion in a related divestment, or I should say, asset-backed borrowing. What's going to happen in 2019? That is the big question. Where is that funding going to come from? And when we see the figures presented by the Honorable Minister, we can make some better judgment as to what our expectations are. This is the graph that I would like you to pay close attention to as an investor and as a citizen. What we are seeing is that public sector debt, net public sector debt, has been going up 62.7% in September 2017. In September 2018, it is projected to go down to about 60.7%, or is at that at the 9-month period. But the 800-pound gorilla in the room, what is government going to do in terms of the Petrotrin $850 million that needs to be paid for in August 2019, which is this budget year, the equivalent at today's exchange rate of $5.78 billion. What it does, if the government takes ownership of this, and if it does not, there are other issues with regard to credit rating. If the government takes ownership of this, the debt gets to our self-imposed limit of 64.3 as at the end of last year. So those are some of the issues, and those are the things that we have to look for in more detail as we go along.